Hello everybody, in this video we'll be looking at the business cycle. So what is the business cycle? Well, it's a key diagram, you might know it as this diagram, and basically looking at the economy as we're going from boom to bust, from recession to recovery. So let me just go on draw mode. So what are we looking at? So this upward line, it's called our trend line. And this is kind of like our productive capacity as our economic growth over time. Over time, growth is increasing. We're expecting our real GDP to increase. We're expecting incomes to rise. We're expecting production to increase. And we're expecting the economy to get bigger. Hence, on average, over time, that line is increasing. Now, we also know that there's a cyclical nature to the economy. The economy doesn't actually always increase. You've heard of the 2008 crisis. You've heard of the dot-com bubble. We have these periods of recessions. We have these Great Depressions. But then again, we also have these amazing periods whereby, the employment rate's high, incomes are high, asset prices are high, and that's what we're referring to by booms. And so, as we can see, fluctuating around this trend line, we've got a boom, whereby real GDP is above that trend rate. It's above the sustainable level of growth. And that's why we tend to have overinflated asset prices, because the economy is overly optimistic. And this tends to manifest as a kind of bubble. When that bubble pops, people become more rational. They're realizing these assets are overpriced. Potentially, there's a catalyst that kicks it off. And then people lose confidence. That's how we go into that recession. People stop spending, economic growth falls. And then, as we keep trailing down this recession, we end up in a bust. And this is like the peak of the recession, the worst part of the recession. You've got a lot of fiscal policy, a lot of monetary policy working to fix this, grim economic period. And that's how we recover into our recovery phase. Confidence picks back up after this severe, extreme policy intervention. And, this cycle, it continues forever and ever. And so that is the business cycle. So let's just look at the characteristics of each, period on the business cycle. So the first period we're looking at is our economic boom. This is where we have high GDP, high inflation. Now we have high inflation because our GDP is high. So if we analyse this using a graph, we know that our aggregate demand is equal to our consumption plus our investment plus our government spending plus our net exports. Now, if you've got an economy where everyone's very confident, there's a lot of spending in the economy, you've got high employment, then you're going to have high aggregate demand because consumption is going to be high, investment's going to be high, exports are going to be high if your export industry is doing well, potentially. Not always, but you're going to have high consumption, high investment. And so, say you're originally operating at AD, which is your AS curve, we've got equilibrium at P star, Q star. Now AD is going to be increasing, so AD shifts outwards because of that high consumption and investment, meaning we've got a new equilibrium at P1. I probably should denote this as Y, so instead of Q star we've got Y star and Y1. And we can see that real GDP has increased. And as real GDP is increasing on our AD diagram, that's what's happening here. We're going into that boom. And yeah, we can also see that the price level is increasing, meaning that we're going to have higher inflation. It's what we call demand side, demand pull inflation, because it's being pulled from that aggregate demand side of the economy. Naturally, we're going to have higher tax revenue. Well, if you've got more demand, you've got more people buying things, that's going to be more indirect tax revenue. You also got more people working, so you've got more direct tax. More corporations, again, more corp tax. All of this is good for the government. We've already kind of spoken about this, but there's going to be high confidence. If you've got high job security, then you're going to be more willing to spend more in the economy. Likely, high investment. These firms, they're receiving a lot of revenue because people are spending, so they're going to invest more. And then we also have high asset prices, and that kind of links to the confidence type kind of thing. If people are confident in the state of the economy, they're going to be very confident in businesses, so they're going to invest maybe in the stock market, and the valuation of these businesses are going to skyrocket during an economic boom. And finally, kind of spoken about this as well, but we've got low unemployment. Reason being is that we know from micro that labour is in derived demand. What that means is that the demand for labour is derived from the action that labour is being employed to take on. And so if there's a lot of demand for goods and services, there's going to be a lot of demand for labour to deliver these goods and services. So you're going to have a high employment rate. And so what policies are going to be implemented during a boom? So we're going to look at our two main policy categorizations. We've got our fiscal policy and our monetary policy. And so, actually in a fiscal policy, we're going to have contractionary fiscal policy, whereby we're reducing spending and increasing taxation. This is because, tax revenues are naturally going to be higher, so it's a nice time period to pay off national debt. Additionally, we've got that high inflationary pressure, and potentially that inflation is going to be above our 2% rate. And so, actually, we need to target the demand side of the economy. And so what actually happens when we employ this contractionary fiscal policy? Well, let's draw our aggregate demand diagram one more time. So we've got our AD, we've got our AS, we've got our original equilibrium, assuming that we're in an economic boom right now. That price level is too high, let's say it's 10%, and we've got a high level of real GDP. Now, if the government is reducing spending, that's going to pull down government spending in our AD formula. And so AD is going to shift all the way inwards here. So it's now at AD1. And now our price level, again, because on the demand side of the economy, we're reducing that demand, so reducing inflation. P1, maybe that's 2% of inflation if done perfectly. And that's what the government really are aiming for. Also, we've got contractionary monetary policy, the increasing of interest rates, and not pursuing quantitative easing, so not printing that electronic money. And again, that is because the primary role of the Bank of England when doing monetary policy is to reduce inflation. And so they want to target this demand side inflation. Again, if you're increasing interest rates, increasing the cost of borrowing, that's going to make consumption and investment a lot less attractive. So you're going to have that inward shift of aggregate demand. Now, a lot of people get confused. They kind of think, why would we want to contract the economy when it's doing so well? Well, the reason that is because, the economy is doing very well, and that's true, but it's producing over that trend line, meaning that the economy is producing at an unsustainably high rate. And, the bigger the boom, so if the government didn't intervene, the boom might get all the way up here, well, then the bigger the crash, so the more damage there's going to be. And so we want to limit that. We want to stay as close to the trend line as possible. This would be a better kind of scenario because a recession would be a lot less severe. Okay, so now let's think about what actually is a recession. So the formal definition that you need to know for your exam is that a recession is when we have 2 consecutive quarters of negative economic growth. So we've got falling employment. People are starting to lose their jobs because demand is falling in the economy. We've got falling GDP, the aggregate demand is shifting inwards. You're going to have less national income. We've got falling inflation rates, again, because AD is shifting inwards. There's less demand for goods and services, and so firms, they're reducing the prices to try and attract more demand. And falling confidence, people are seeing those around them losing their jobs, and so, themselves, they're not going to be very optimistic about the economy. Also got falling asset prices. People are less optimistic about the economy, they're less optimistic about firm performance, so they're going to withdraw their investments. And this is measured often by the fear and greed index. So I believe it's updated potentially weekly, and it gives you a measure of the sentiment in the markets. So you've got extreme fear, you've got greed. Whereabouts are we? Usually in a recession we're going to be in the extreme fear, whereas when we're in a boom we're going to be in the greed section. And so also we've got low incomes, people are losing their jobs and being made redundant. That's not a great thing for your income. Finally, also we've got reduced investment. Again, firms, they're a bit uncertain about the future. They're receiving low demand, and so why invest now? And so what actually is a bust? Well, it's the worst part of a recession, so it's the peak of the recession. It's when all the above metrics that we just spoke about are at the worst. So the economy is going to be at its lowest growth rate, the point of highest unemployment, etc. And so, policy during this time is very, very important. We want to employ both expansionary fiscal policy and monetary policy. Well, expansionary, we're trying to expand the economy. The economy's contracted so much from this bust, from this recession. And so what we want to do is we want to not reduce spending, we want to increase spending. And we want higher spending, so maybe we're spending on education, maybe we're spending on health, maybe we're spending on infrastructure. If you remember, during the COVID-19 recession, we had the Eat Out to Help Out scheme, and that led to a lot of people just going out and spending a lot of money. And so the reason being is that, again, if we look at our aggregate demand formula, AD equals C plus I plus G plus X minus M, the more the government spends, just assuming that everything else stays the same, government spending rises, then aggregate demand rises. Schemes like Eat Out to Help Out, well, the government spending rose, but that also led consumption to rise. And it's a good thing to remember that we have a multiplier effect. So even if the government spending rises, I don't know, by 1 billion, then potentially aggregate demand might rise by more, might rise by 2 billion, depending on the size of that multiplier effect. If you've not heard of the multiplier effect yet, don't worry. You'll probably get to it in class, or I'll make a video on it in the future. So again, this is kind of wrong. The government will want to decrease taxation. I must have forgot to update the slides. But by decreasing taxation, you're making spending a lot more easy to do. People have more income, so they're going to consume more, etc. The goal of this is just to increase growth. You want to increase that aggregate demand. And so, one of the big criticisms for fiscal policy is that it's going to lead to an accumulation of debt. Reason being, well, if you're increasing spending, you're having less tax revenue, you might have to borrow a lot of this money. And naturally, you've got more debt, you've got to pay more interest on that debt, which might lead to austerity in the future. Austerity is when you have to increase taxation and reduce spending. A lot of the time, also, austerity might push an economy even into a recession. We've also got the monetary policy side of things. So that is when we want to reduce our interest rates and pursue quantitative easing. Reason being is that we want to increase growth. So if we reduce our interest rates, we're making the cost of borrowing very low. For example, if interest rates fall from 5% to 1%, for people that had a loan of £100, the interest payment on that £100 at a 5% rate of interest would be £5. Whereas at a 1% rate of interest, it's going to be £1 interest. So it's going to be a lot cheaper to borrow money. As a result, more people are going to borrow money, and people are going to spend in the economy. That's going to drive consumption up. Also, it's going to drive investment up because you're going to have businesses that are also borrowing. We've also got that quantitative easing side of things. So that is when the Bank of England is going to print money. And again, that's going to increase economic activity. Okay, so our final stage of the business cycle is the recovery stage. And this basically happens with time and correct policy. The economy, it begins to recover from that bust, from that peak of the recession. GDP will slowly start to rise, unemployment will fall, so the employment rate is going to rise, and inflation is going to pick up. And that cycle is going to continue. You're going to continually get that boom, then that bust, and that boom, and that bust, all onwards until, just forever, basically. And so that's the basic logic of the business cycle.